And the thing with these banking concepts is not that the banking concepts are bad. Be Your Own Banker or Infinite Banking, there are a couple others. It's not that they're bad. Certainly the products are not bad. Whole life insurance is great. You know, you have permanent coverage. You're paying for dollars with pennies. You're putting in pennies and premiums to get dollars of death benefits. There's a savings component that's tax deferred. You can access that, potentially tax free eventually. I want to be compliant here, potentially tax free eventually. Chronic illness riders, many times. In recent history, these whole life policies have generally been able to get a little more interest than otherwise conservative products out there. Whole life insurance is a beautiful thing. The problem with these banking concepts is the fluffery has just been blown out of proportion, right? I've heard this a couple times over my career, and I guess this isn't just whole life or infinite banking, but I've heard this, and it makes me cringe every time I hear somebody say this, although now it's somewhat of a joke. Mrs. Client, have you ever heard of a Section 7702 plan? Have you ever heard of this? Well, of course you haven't. That evil banker, those evil bankers that have those nice, big, beautiful buildings, these bankers that rule the world, that stockbroker that wants to lose all of your money, these evil people, they've never told you about this because they don't want you to know about it. Let me tell you about a Section 7702 plan. You know, that's just one of many examples. But then you get into the mental gymnastics of the technical stuff, right? Consumers that don't understand opportunity costs because they don't have an economics degree, the consumers that don't understand time value of money, maybe because they don't have a finance degree, it's very easy to confuse them with this stuff, right? Whole life insurance is not something where you can put in $1 and immediately turn it into a couple dollars. And I'm going to show you an example from an agent to where that is kind of the perception a lot of times with these concepts. It is as simple as two different sides of the balance sheet within one product. Let's go to a bank. If you go to a bank, you have $20,000 in savings, and let's say that you need $10,000. You have a choice. You could take out $10,000 from your $20,000 asset, your savings, or you can get a loan from that bank, right? Banks have assets and they have liabilities. And let's say that you're getting 6% on your money, and let's say that you have to pay 4%. Well, I like that scenario. I'm going to use somebody else's money in that example. A life insurance policy is the same thing, or a whole life insurance policy is the same thing. You have both sides of the balance sheet. You have cash value that can accumulate, but then you have the potential to take loans from the insurance company where you pay the insurance company interest, and that loan is secured by the cash value. But again, you get into these word games, right? So because you're paying 4% on your loan and the historic dividend rate has been 7%, Mrs. Client, when was the last time your banker, that evil SOB, when was the last time he paid you 3% for you to take money from him? That's what this policy will do here. And by the way, and never interrupt the compounding over here. It's the same freaking thing as what I just explained over here. These are not magical money-making instruments here. Now, the concept, the be your own banker concept, it's okay, right, if used correctly. It's a forced savings mechanism. If you're overpaying for the insurance in the early years, which is what whole life does, and therefore have a certain amount of cash value because you've had a forced savings mechanism and you can tap into that, well, that's a good thing, but not the word games that I'm talking about. So this agent calls me up a year ago. He says, Charlie, I have a client who wants to dump $20,000 into a policy, $20,000 per year. And I've been reading about these infinite banking concepts in some of the agent chat boards online. And I want to talk with you about it. And I'm like, okay, let's see what he says. It says, now question, when my client dumps in $20,000 up front, how quickly can he get access to, say, $10,000? Said, well, pretty much immediately. With XYZ product over here, you can actually send the loan paperwork in with the actual application, the product application. I said, now I would submit to you that maybe if he has $20,000 but needs $10,000 immediately, then maybe there are better ways of securing his $10,000 than funneling it through a life insurance policy, like a high frequency trading or a high frequency loan scenario. I'd submit to you that, but technically could get $10,000 access immediately. Goes, okay, let me ask you a question. What's my commission on this? I said, well, the commission would be whatever it was. I don't remember, but let's just say 75%, just to say that. So $15,000 on $20,000. He goes, okay. So let me ask you a question. If my client does monthly modes instead of annual, so puts in $1,666, do you annualize my commission? I said, if you're the right agent, if your background checks out, otherwise I get stuck holding the bag if there's a chargeback. I said, if you're right agent, I'll annualize it, which is almost like you get paid based off of the entire $20,000 going in, or, 3/4 of the year's premium going in. I said, yeah. So I would annualize you if you have the right background. So consider that $15,000. He goes, okay, let me ask you a question now. So if my client pays monthly, can they immediately still reach into the policy and access $10,000? So let me see here. Let's review what we are proposing that this policy can do. $1,667 goes into the policy. That's what the insurance company is receiving in month one. And what you are saying is you would expect the insurance company to give you $15,000 in commission, even though they only got $1,600, which they will actually do this. But then in addition to that, you are thinking that somehow magically that client is going to have a cash value of at least $10,000 based off that $1,600 premium. So $25,000 paid out, even though only $1,600 went in. No, that's not the case. My point here, folks, is many times even agents don't know what is true and what is not true because of all the fluffery that's been blown out of proportion when it comes to these concepts. The products are great. We don't need the fluffery. Even the concept is great. We don't need the fluffery, that forced savings capability that whole life insurance has, so that eventually, if they want to take a fairly cheap loan, the insurance company has a 4% loan rate or something when interest rates are 8%. Well, by all means, access money in that policy. A 4% loan rate is good. Take out $10,000. It's a beautiful thing to use that as a bank, right? It's the fluffery that I don't like.